guys, what's up? I'm Erin and welcome back to Erin Talks Money. At first glance and first impressions can make investing look kind of difficult. It can be kind of confusing. People can look at it and say, I don't understand the stock market, and what is an index fund? What is a growth fund? And what is a dividend fund? What is arbitrage and puts and calls? And with that, they can throw their hands up and say, you know what? I'm just gonna put it off. It's something I'll get to one day. And it turns into that kind of situation where we say, it's something I'll do one day. Like all those home improvement projects that we all say we will get to one day, but that day never actually comes. Well, it doesn't have to be that way with investing. Investing is actually really simple. With a basic knowledge and just a few minutes time, you could have your own accounts opened up and ready to invest in. But there are a few rules that every investor must follow. So I'm gonna go over those in this video today because anything worth doing is worth doing right. And you don't wanna waste any money and you want to ensure yourself a bright financial future. But the good news is all of these rules are really simple. They're very easy to follow. So without further ado, let's dive right in. Rule number one, just start. Yes, I get it. That seems like a weird rule to have, but it's a very important one. You have to start investing. This is actually the number one regret of all retirees, so don't make the same mistake. People put off investing for so many different reasons. They say, I'll start investing once I have a better paying job, or once my car is paid off, or after I buy my first home. You need to stop with the excuses. The very best thing you can do for your future self is to start investing today, literally right now, because your first dollars that you invest are your most powerful. They have the most potential for growth. The dollars you invest at 20 are more powerful than the dollars you invest at 30. The dollars you invest at 30 are more powerful than the dollars you invest at 40, and so on. For example, if you invest $1 in the stock market at the age of 20, it has the potential to grow to $73. If you invest $1 at 30, that has the potential to grow to $28. And if you invest $1 at 40, that has the potential to grow to $11 by the time you want to retire at 65. Just look at how quickly those numbers taper off as each passing decade goes by. It's actually kind of scary. That is why you have to be investing as soon as you possibly can. Get your money working for you. The sooner you invest, the sooner you can start working towards your financial goals. The sooner you invest, the sooner you can achieve those goals. So give your money the best opportunity to grow by starting today. Start as soon as you possibly can. It doesn't matter if you're starting with an employer-sponsored plan, whether you're opening your own brokerage account. If you are, I recommend accounts like Vanguard and Fidelity because they have rock bottom fees and they truly look out for investors. But start investing as soon as you humanly possibly can. Number two, don't pass up free money. If you work for an employer who has a 401k or a 403b with a matching contribution, make sure that you are enrolled in this plan and that you are contributing at the very least up to the match. You do not want to pass up free money. You do not want to leave free money on the table. Now remember that every company has a unique structure when it comes to matching contributions, so you're going to have to look into the specifics for your company, but a common one is a 4% match. So that's what we're going to use for our example today. Now let's say that you make $50,000 and you work for an employer that does that 4% match. That would mean you'd have to contribute 4% of your pay into that 401k option. In this case, that would be $2,000 to capture 100% of that 401k match. So if you put $2,000 into that account, the employer will then come along and put $2,000 into that account as well. First of all, that is free money. Why would anybody pass that up? But second of all, and more importantly, we have to look at the effect on this matching contribution over the course of an entire working career. If you contributed just $2,000 to your investments without any employer match from the time you were 20 all the way up to the time you were 65, it would grow to roughly $800,000. But with an employer match, that fund would grow to $1.7 million. And this doesn't even factor in a potential increase in salary over the years or increases in your contributions. Don't leave free money on the table. Even if money is tight, Find a way to contribute at least up to the match. Don't leave free money behind. Make sure that you capture 100% of that employer match if it is an option available to you. And the bonus with these accounts is that they're tax advantaged. So all the money you put into them gets to grow tax-free over the entire course of your working career. Number 3 is KISS. Have you heard of the KISS principle? Keep it simple, stupid? Well, that definitely applies to your finances. You don't need to overcomplicate anything. You don't have to worry about picking the next Amazon or picking the next Tesla. You don't have to worry about what those talking heads on the nightly news are even saying, because after all, everything they're saying, they are doing for ratings and advertisements. They are not trying to help you with their finances, no matter what they say. The best thing you can do is drown out all the noise, because at the end of the day, picking individual stocks is a loser's game. Even fund managers, professional stock pickers, can't beat passively managed index funds. So if these professionals who are highly educated, doing this every single day for 8 to 9 hours a day, who have access to every single bit of information on a company that they're investing in, can't beat the stock market, why would you think you could? So unless you have the Midas touch or you've been blessed by the stock market gods themselves, stick with index funds. They consistently come out ahead again and again. Don't worry about picking individual stocks. Honestly, it's a lot more work, and very rarely does it turn out to be the better investment choice. Rather than picking a couple stocks and hoping that they do well, buy all of the stocks. Buy an index. Buy the one that tracks the S&P 500, or go with a company like Vanguard and choose their total stock market fund, which actually invests in all of the stocks in the US stock market. Or go with Fidelity. They also offer a total stock market fund, and again, it invests in all the stocks in the market. Remember, the stock market goes up long term, so you invest in the entire thing, your money is going to go up. These funds have a long track record of positive returns, and they are very reputable companies with rock bottom fees. Stick with index funds if you want your money to grow at a reliable rate. Rule number 4 is set your investments on autopilot. You want to be contributing to your investments as often as you possibly can. And for most of us, that's going to be on a monthly basis, because most of us have a typical day job where we get paid bi-weekly or monthly. Practically every single bank has the ability to set up automatic withdrawals and automatic deposits. And if yours doesn't, you need a new bank, one that's up to date in the 21st century. So all you have to do is to go into your account, select the date, select the amount, and schedule it. Your automatic deposit is now set. Once you schedule it, you can forget about it. You go on, you live your life, you do other things that don't involve investing every single day. Because I get it, that's not on everybody's mind every single day. That's why you schedule it. If you don't schedule it, odds are you're probably not going to end up investing every single month. You're going to leave your money uninvested, and it's not going to be working for you. Humans, we are notoriously forgetful. Like if I asked you, what did you have for lunch on this past Saturday? You might not remember. If you don't remember, that's a normal response. We are forgetful. If you're simply just counting on your ability to go in and manually make these deposits every single month, you might find that it actually doesn't happen on a regular basis. You might find that you've spent all your money for that month and you don't have any leftover money to invest. Make your contributions automatic. Set it up so you don't even have to think about it. Ideally, you'd want to set it up to be the day right after you get your paycheck, so you know that money is there, but then it's taken out of the account before you ever even see it, before you have a chance to spend it. Now that is how you make yourself an automatic millionaire. Rule number 5, don't worry about stock market volatility. Long term, the stock market goes up, but short term, it's anyone's guess. No one knows what the stock market is going to do in the next several months, in the next several weeks. No one knows what it's doing in the short term. It could go up, it could go down, it goes sideways. No one knows. But over the long run, the stock market has given us an average annual return of about 10%. But by no means is it a smooth ride. Some years that stock market is up 30%, other years it's up 5%, and even other years it's down 20%. In the long term it goes up, but short term, no one knows. That's life, and that's the stock market. The stock market reacts and overreacts. It overreacts to economic data, presidential elections, news reports, international news. The very best thing you can do is to ignore it all. Remember, investing in the stock market means you are a long-term investor. Stay your course. Don't react. Don't be one of those people who hops in and out of markets based on what the news is spewing out to you. That is a surefire way to lose money. Just keep investing. Keep building your net worth. As a long-term investor, you are guaranteed to see bubbles, to see periods of booming growth, to see recessions, and to even see crashes. But remember, long-term, the stock market goes up. You just have to weather those storms in between. Rule number 6, diversify. This is how you reduce your risk. So how do you diversify? You don't put all your eggs in one basket. Ideally, you're going to take your investing dollars and spread them out over many stocks in many different industries. Back in the 90s, owning tech stocks was all the rage, and it was very good and very profitable until that bubble burst in 2000 and it crashed. Owning Tesla is awesome until suddenly its stock plummets by 34%, as it just did in September. Ignore the trends. Trends come and they go. What's hot today will not necessarily be hot 6 months, a year, or even 5 years from now. And many newbie investors are getting started investing on platforms like Robinhood, which is great that they're investing, but these kind of platforms encourage individual stock buying and trading, not long-term investing. And as a matter of fact, the average Robinhood user has just 4 individual stocks. That's not diversification. The very best way to diversify is through the use of index funds, and even better yet, make use of target date retirement funds. For example, how about a Vanguard target date retirement fund? These funds could not be more simple. All you have to do is select the retirement date fund that coincides when you are roughly planning on retiring. After that, these funds really take care of themselves. You just put your investing dollars in and it will disperse it over several index funds held within the overall target date retirement fund. Usually these funds are the US stock market index, the international stock market index, as well as other asset classes like the US bond market, as well as the international bond market. These are the ultimate set it and forget it funds. They mature with you. When you are younger, they are heavily weighted towards stocks, so you get the most aggressive growth. However, as you get older, these funds will distribute more of their investment towards bonds, so they get less risky as you mature and as you approach retirement. And number 7, don't go all in. Invest as much as you can and invest as often as you can. But remember, your long-term investments are only one piece of your overall financial puzzle. They are not the full picture. Your life is dynamic, and it's very likely that you're saving up for some near future goals, like maybe you have a wedding or a vacation you want to take, or maybe you're saving up for your first home. And of course, we all need an emergency fund because, well, emergencies happen. You don't want to put money you're going to need in the near future, say in the next 5 years or less, into the stock market. It is just too volatile for that. What would happen if you needed this money in, say, 2 years, but the market crashed and now that money wasn't there? You wouldn't get to pay for that wedding, or you wouldn't have that down payment on the house. You need to have other accounts that are for shorter term goals that you can have readily access to, and they're in stable accounts that don't fluctuate so much. The stock market is a very volatile place. No one knows what is going to do in the next day, week, month, or even the next year. Keep money that you are going to need in the near future out of it. Only put your long-term investments in the stock market. Yes, long-term, the stock market goes up. Yes, I think everyone should take use of the stock market because it is a great investment in your future. But short-term, money does not need to be in the stock market if you're using it in the next couple months or in the next couple years even. Make sure you have access to funds funds that you're going to need in the near future, and make sure they are not in the stock market so you can be sure that they're there when you need them. So there you go. Follow these tips and these rules and you will have a bright financial future. They aren't hard, but most people don't follow them. You can beat the masses by keeping your financial plan nice and simple. Simple is one of the best things you can do for your finances. But that's gonna wrap it up for me today, guys. I post new videos every Monday and Thursday. If you liked what you got in this video, please give it a like on the way out. If you're new here, subscribe, and if you know of anyone who could get anything at all from this video, please consider sharing. So I hope you guys have a good one, and I will see you soon. Bye.